Let's also now go across to our first guest on the show. Aveek Mitra is now with us. Aveek, can you just start by, talking about the markets? How have we ended 22, where actually our P's have expanded across the board? What do you expect for the following year?
Hi, good afternoon. On the short term, we expect that market will remain volatile because number one is that this increase in rate by Fed has increased the pressure on the rupee also, because if you see, rupee has actually weakened, even though it is not looking like that because it has gone up to 83.5. But dollar has decreased by almost 10% vis-a-vis that rupee has only decreased by about 3-4%. And otherwise, also we have to look into the next RBI policy, where let us see where the interest rate ends. And also, it is a holiday period for the global investors, and also rebalancing is on in the MF, and many of the people are on the holidays, so the trading volumes are low. So market remain volatile in the shorter term.
When we just look at the flows, what do you expect? This has been a year where FIs have been sellers. Still, Indian markets have done well. If they come back, do you expect an upside, or you think valuations are full and that's why, it may be difficult for them to come back in a bang?
I think the FIs will come back because last year they sold it quite a bit, but market was remaining steady courtesy our local investors. And local investors' faith will remain so, though there may be certain kind of rebalancing of the MF portfolios towards the debt funds. But even then, a particular baseline flow will be there. And global investors last year, if you remember, they have lost big amount of money in Russia. And I don't think that they want to really increase their exposure to China that much because of the geopolitical issues. So even though the China market looks much cheaper compared to India, and Indian market looks relatively much more costlier, but I think that FII flow will slowly come in.
You pointed out an important situation about China, but China is also reopening. They are changing than what they were earlier. It's a very big market where a lot of money can be deployed. Can you talk to us about that? You expect that also to happen, but that, of course, will regenerate emerging market as an asset class as well.
Yeah, so there are two parts. As China is an independent MSCI allocation is there, and for India, actually, it is all part of this emerging market basket where the weightage has gone up from 8% to 15%. That itself will increase certain amount of money flow towards India. And secondly, I do not think that a lot of big incremental money, even though their valuation is cheap, will go back to China, because China remains an unpredictable, and with every passing day, the unpredictability of the Chinese political situation and the economic situation is getting a little trickier for the global investors to really have faith. And remember, China is also on the facing a large issue regarding the real estate bubble. So if something happens on the Chinese market on the real estate side, and some banks go belly up, then that risk actually can create a global contagion. So those risks may be there on the Chinese part. The valuation is not the only thing. People also look for the comfort of their capital, and they also look for taking easily out the money, which that kind of problem is not there in India, and I don't think that will ever happen in India in any foreseeable future.
In terms of financials, are you comfortable after the recent run-up? You think financials could do well over the next 6 to 9 months?
Financial means, if you're talking about the PSU banks, I really don't know, because with PSU banks we don't really track, because yes, PSU bank books has been cleaned, but the internal culture and the structure of the governments and things like that has not changed much. So I think this is a good rally, and the rally may continue for some more time, but we are not into it. And on the NBFC part, we are selectively bullish on this, but at the same time, there is a minor issue which actually we should keep in mind, that I think the retail frenzy of retail credit has reached a stage where I think it further goes up is much low compared to its remaining steady, and there may be certain pockets from which a kind of bad loan or a kind of credit risk come up. So we need to be cautious in this sector, but at the same time, yes, The opportunity size is so big that if somebody wants to invest for a very large long term, then they can look into it. And we also look into it certain selective areas.
So when we just look at the new age companies, there has been a big decline over there. Are you a fan of any of these new age companies, or you expect more correction and probably you look after that?
New age companies, we were not invested till few days back, and we have very recently invested into one. We also always had this problem of valuation about the sustainability and the continuity of the business model and path to profitability. So all these issues has kept us away, and I think we did a right thing because most of the valuations has been corrected substantially, and investors made huge losses on those investments over last 1 year. But now, few of these companies where we feel that the valuation has come to a level where it can be nibbled into those areas, and where actually we can see that there is a path to profitability. So we have recently invested into one, not in Zomato, but or not in the Paytm kind of stocks, but yes, in the space where there is a steady revenue possibility are there, and the involvement of that particular sector is there is only one company actually in this sector which is there on the online space. And secondly, I think this sector needs to be looked into now because the increasing cost of money and the drying up of VC and PE funds into the sector will leave them a certain breathing space to actually grow their businesses without competition actually breathing down their shoulders. So that kind of opportunity is there for this company. So we will be selectively looking into it, and we recently invested in one.
So when we just overall talk about how things are moving, you expect any of these cement companies? We've seen great consolidation. After that, some of the companies have gone well, some of the companies have gone down. Do you think some of these traditional sectors like cement, steel could once again be in focus in the following year?
Yeah, possibly so. Because the thing, if we whatever we are reading in the papers about the construction sector, if it is true, then I think the construction sector demand will come up. That is one side of the story, and the other side of the story is that government is really putting a lot of money into the infrastructure sector. So all this over well for this, but how much uh, price will go up for steel and all will depend on global demand and supply situation. On a global recession situation, how the steel sector will do, I am not really very sure, but the cement is a local industry. It is a geographically concentrated industry. So it depends on actually which area the cement plant is situated, what is their interland is they're catering to, how far is there from their uh, coal mines and raw material sites, and how far the distance that cement has to travel to this end customer. All these things actually decides on the valuation of a cement company on a particular time. So that is one side. Other side is that there is a consolidation happening in this industry, and also new companies are coming into this business with a very large capital base. So keeping that in mind, yes, we are selectively investing into the cement, but our present investment is very low, almost insignificant. We will look into it as the time goes by, and then we will make the decision. Also, we will need to see how the rural demand and rural housing is going. Based on that, we will take the decision on really taking any serious exposure into the cement sector.
Got it. So, right. So, what you said is essentially how these companies have been valued at. But if we look at the last 3 years, don't you think a lot of these steel companies have paid back their debt, improved their balance sheet, announced capex at a slightly asset-light model, or are going slow and not taking debt? Similar the case with the cement companies. So, what do you make of this improvement in the balance sheet that they have now?
Yeah, obviously, all these have made improvements in the balance sheet. Specifically, some kind of completely debt-ridden companies have reduced. But I think that those things are already known. So, as an investor, I need to see that I have to pick up 25 stocks, and I have to see that I am picking up the best 25 stocks for my investors. So, I look into it this way. Yes, these are good, but is it good enough to be a part of the portfolio? Till now, I don't think that that is the case. There are enough 25 opportunities out there in the market right now to put my money where investors can expect a decent predictable growth, because I need to see that this is also coming, this return is also coming in a manner where at the volatility is to a large extent managed by us. That is our job on the fund manager. So keeping that in mind, I'm not yet invested in the cement in a big way, and no investment is there on the steel. And I don't think in foreseeable future we have a plan of investing in steel, except one company which is actually supplying ore. That is the company where we are invested in, because we think that when the China opens up, there is a possibility of that company doing well, because they are a large exporter to China of ores.
All right, sir. Thank you so much, sir, for taking out time for us. Season's greeting, and hope you have a happy new year
This is greeting
in
to you too. Thank you.
2023.
Thank